A legend is told on Wall Street. When darkness engulfs the markets and uncertainty paralyzes traders, bewildered investors know they can look up to the sky. 3 stars always shine there, even on the darkest night. They are called the 3 oracles. 3 titans capable of reading the future in the numbers, of sensing the coming storms before they even break, and of transforming chaos into great fortune. The first of these oracles, he is known as the Immortal. 94 years of age, with 75 years in his illustrious career, and never once a single losing decade. Warren Buffett, the patriarch of Omaha, who has consistently beaten the markets for 7 decades. The second is Cassandra, the man who foresaw the 2008 crisis when everyone else was dancing on the Titanic. Michael Burry, the solitary prophet, who consistently bets against the crowd and invariably proves to be right. He rarely speaks, but when he does open his mouth, it's always to announce the apocalypse. And the third is the architect, the one who meticulously mapped out 500 years of economic cycles to construct the perfect investment portfolio, Ray Dalio, who has achieved over 7.3% annually for 30 years, through both fair weather and stormy times. But this autumn, something strange is happening. Our 3 oracles have all adopted the same disturbing behavior. The Immortal stops buying stocks, accumulating $325 billion in cash, an all-time record. Cassandra prophesies the imminent collapse of tech and starts shorting American giants. Even the architect, who is usually so measured, breaks his silence to announce precisely when the bubble will burst and what exactly will trigger its collapse. When 3 legends all point in the same direction, the markets inevitably tremble. Our 3 esteemed guides share the same unsettling vision of a dark and chaotic financial future. In this video, I'll bring you up to speed on their latest moves, their most troubling transactions, and I'll reveal why 2026 could very well be the year everything changes. In the world of finance, few names resonate with as much authority as Warren Buffett's. For over half a century, the billionaire has forged his golden path in the stock market, defying all crises. Through him, patience and value have truly found their form. Today, his conglomerate, Berkshire Hathaway, holds approximately $257 billion in securities within its portfolio, alongside $382 billion in cash. That's a lot, but more than the number, it's the trajectory that counts. Only 2 years ago, the situation was completely reversed. Berkshire reported $347 billion invested, and only, so to speak, $157 billion in cash. Since last year, the Oracle of Omaha has completely changed his strategy. It began on May 6, 2024, when he showed pessimism for the very first time in his life. Before the Berkshire Shareholders General Assembly, he gravely announced the end of the golden age of the American economy, and he anticipated a decline in his conglomerate's revenues. A few weeks earlier, he had lost his lifelong friend, Charlie Munger, 99 years old. This might perhaps explain it, but in May 2025, a new significant step was taken. Buffett has introduced his chosen successor, Greg Abel, to take over as Chief Executive Officer beginning next year. I'll let you just imagine the shareholders' expressions, absolutely terrified at the prospect of his leaving, despite his solemn promise to remain chairman of the board for as long as his health and strength permit. This transfer of power, however well prepared, marks the end of an era. So Buffett no longer buys, he accumulates. He's been emptying his portfolio for 3 years now. As of September 30th, 2025, Berkshire holds a treasure of $382 billion in cash and equivalents, representing 57% of its total assets. Between July and September, he once again sold more than $6 billion worth of net shares, which brings the total amount of liquidated holdings to approximately a staggering $184 billion over the course of the past 3 years. Despite these massive sales, the diversification of Berkshire's investments doesn't change much, but the stock portfolio now represents only a third of the group's true value, and that indeed is unprecedented. At the moment, Warren is waiting. He's not looking for the easy score anymore. So, what's happening? In Omaha, some say he's preparing his succession, which is partly true. He wants to give Greg Abel more freedom, a mountain of secured cash as a welcome gift. Nothing better to start a new career. But there must be something else. Others think he's anticipating a correction. Great deals to be made when the crazy tech valuations collapse. When? No one truly knows. He has been preparing for more than 2 years now. Meanwhile, he is content with time deposits and bonds yielding over 5%, and he is buying back his own shares. Since 2020, Berkshire has repurchased nearly $100 billion of its own stock. It allows the Treasury to work. It's more advantageous to buy back shares than to distribute dividends. But it's especially a way to improve profitability per share by reducing earnings dilution. If we reduce the number of outstanding shares, we increase the profitability of the remaining ones. And that's what Warren had been trying to do ever since he realized that the exceptional performance that had made Berkshire famous would become increasingly rare. He hoped to offset the stock's declining performance, which only gained 6% in the past year, a far cry from the 30% seen in 2021. But here's the situation. For 5 consecutive quarters, Warren Buffett has not bought back a single share of Berkshire Hathaway. However, his own established methodology suggests repurchases whenever the price-to-book value ratio falls below 1.4. Currently at 1.55, this ratio indicates that even the Oracle of Omaha considers his own conglomerate too expensive. When Warren Buffett refuses to buy back his own shares, the message is clear. Even Berkshire is overvalued. And if Berkshire is too expensive, then everything is too expensive. It is precisely this kind of relentless discipline that has always earned him the trust of the shareholders. But what will be the case with Greg Abel? While Buffett personifies patience, Michael Burry, on the other hand, embodies boldness. Following in the pantheon of financial oracles, Mike Burry positions himself to the right of Buffett. It is quite a different style altogether. He chose the name Cassandra for his social media accounts. You might know him perhaps for his bet against the subprime crisis in 2008. It was so incredibly crazy that they even made a movie about it. Why Cassandra? He sees himself as the one who issues warnings, but no one ever listens to him. For you, an informed investor, following Burry means considering an alternative scenario, one we don't want to see, even if he isn't always right. For example, he shorted the S&P 500 and the Nasdaq in 2023, and he took a hit, minus 38% on the Nasdaq and minus 16% on the S&P 500. Today, he manages his personal investment fund with which he handles his own money, Scion Asset Management. The fund, per latest data, manages about $1.38 billion. On November 4th, Mike launched an offensive by taking massive short positions. We're talking about put options for nearly $1.1 billion, leverage included, against artificial intelligence giants like NVIDIA Corporation and Palantir Technologies. Like Warren, Mike anticipates a bubble explosion, or at the very least, a serious backlash. At the same time, the fund also opened new positions, less spectacular but just as significant, including calls on companies like Estée Lauder Company, Lululemon, Athletica, and United Health Group. These moves indicate a clear diversification towards consumer goods and healthcare, sectors that are generally more resilient during a technological crisis. Burry isn't just looking for buzz. In general, he opposes his vision to the dominant trends. As everyone celebrates the rise of AI, he announces, and I quote, that we sometimes see bubbles, but he also would have seen something more. According to him, cloud and AI companies, Meta, Google, Microsoft, Amazon, or even Oracle, would artificially inflate their results by manipulating the depreciation period of their IT equipment. By extending the accounting life of servers and chips that quickly become obsolete, they would reduce their expenses and boost their profits. Burry believes that this manipulation could conceal almost $176 billion in depreciation by 2028, and that this fraud is fueling the overvaluation of the technology sector. By the way, if you want to stay informed about this potential bubble, just subscribe to the channel. It's free, takes just 2 seconds, and helps us tremendously. But back to the topic, the signs are definitely bad. Buffett is accumulating cash, Burry is screaming apocalypse. The third oracle remains, the architect. Ray Dalio does neither of those. He just calculates. But this time, even he is sounding the alarm bell. Ray Dalio, he's not one to be swayed by mere rumors. He has nerves of steel. Nothing phases him. Not even a war. Confronted by the immortal who waits and the Cassandra who speculates, the architect continues to build meticulously, brick by brick. He diversifies his assets across the world, investing in more than 70 sectors, combining stocks, bonds, commodities, and currencies. He seeks less to predict the market's next mood than to remain resilient when the tide rises and when it recedes. When Ray founded Bridgewater Associates, his mission was to create a portfolio that could withstand all economic conditions: inflation, deflation, chaotic growth, or stagflation. His famous all-weather portfolio is based on a simple principle: global diversification and risk management, rather than seeking a big stock market hit. It is extremely diversified and contains thousands of assets. It's difficult to track every single movement, but the typical all-weather portfolio structure is comprised of about 30% in equities, 40% in long-term bonds, 15% in intermediate bonds, and 15% in commodities, including gold. Over 30 years, this strategy has posted an annualized return of about 7%, and it significantly reduces volatility. But this autumn, for the very first time, Ray is worried, and the cause of his concern is the Fed, the American Central Bank. On November 5th of last year, he published an analysis that he titled, "Stimulating the Economy in the Middle of a Bubble." In his view, the Federal Reserve is making a monumental error right now. To explain it simply, It all begins with the public debt. The United States continues to borrow heavily, particularly short-term, to finance its deficit. However, since there aren't enough buyers for all this debt, the Fed is compelled to purchase some itself. In other words, it prints money to finance the government. When the Fed acquires government bonds, this process is known as quantitative easing, a form of monetary loosening, and by doing so, it injects currency into the financial system. Real interest rates are declining, investors have more available cash, and since they must put this capital to work somewhere, they're buying stocks, gold, and real estate. Prices are rising, but it's a purely mechanical effect because the underlying fundamentals aren't keeping up. No new wealth is being created, nor are more resources available, and that's what causes a bubble to inflate. Dalio points out that quantitative easing is normally employed during periods of crisis, when markets are at their lowest, inflation is low, and the economy is stalled, to restart the economic engine with fresh capital. But today, the Fed is purchasing assets even though everything is already overheating. Stock prices are already very high, the American economy is performing well, inflation is above its target, and credit is already flowing abundantly. It's like pouring gasoline on a fire. We risk creating an even larger bubble. But Ray Dalio, he's a true professional, and he doesn't stop there. He also tells us when the Fed is going to stop. And according to his analysis, this critical moment could occur between the second quarter of 2026 and early 2027, precisely when the Fed will have to choose between continuing to finance the debt or letting interest rates explode. The moment the Fed must reduce its debt purchases or raise its rates to calm inflation, when it shifts from quantitative easing to its opposite, tightening, that's when the bubble will burst. Clearly, it will start with the sector where the most money has gathered, tech. Here's a tip for you. Keep an eye on Powell's decisions. That's where the signal will come from. Meanwhile, Ray suggests increasing your gold and precious metals to 15% of your wealth. So to summarize, Buffett is waiting for the crash and holding on to his anti-fragile assets. Mike Burry is waiting for Nvidia to fall. And Ray, for his part, keeps his gaze fixed on Washington. However, there are those who don't believe it. Palantir CEO Alex Karp reacted strongly to Mike Burry's short position, valued at nearly $912 million. On CNBC, he called Burry's bet completely insane. He accused him of trying to manipulate the market and stated he was highly motivated to publish better results to make Mike poorer. We find the same behavior towards speculators from Karp as we saw from Musk when Tesla became the focus of their attention a few years ago. At Nvidia, management dismisses doubts about an AI bubble. CEO Jensen Huang, who was present at the recent GTC conference, states he doesn't believe in a scenario comparable to the dot-com bubble of 2000. According to him, it's the real demand for AI chips and specialized architectures that supports the exceptional growth of the firm, whose value has exceeded $5 trillion. Even though many analysts and institutional investors share our legendary trio's concerns about Nvidia's speculation and valuation, Huang insists on the structural and lasting nature of these investments, reminds us of his strategic partners, and shows that his order book is full. Between the two camps, other players are more moderate. Goldman Sachs or Morgan Stanley also anticipate a significant market correction, but they don't fear it leading to a brutal collapse of the sector. And such an event should not last for long. It's about realigning market prices with actual performance. But frankly, when Buffett, Burry, and Dalio all point in the same direction, it's never a coincidence. Here we are in 2026, and the three oracles have spoken. Now, it's up to you to choose your side. Are you more like the Karps, the Huangs, and the Musks? And do you believe that tech is still in its very early stages? Or would you be more inclined to follow our esteemed oracles? Tell me everything in the comments below. I can't wait to read what you say.